Okay, it's 9 o'clock, so we'll get started here. Good morning, everyone. My name is John Von Paris, and I am the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. I ask that those who are presenting or answering a question to please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. This time we will begin with agenda item number 1, the approval of the open meeting minutes from November 9, 2023. Is there a motion to approve the minutes as presented?
So moved.
Thank you, Member Carroll. Is there a second?
Second.
Member,
Thank you, Member Rosen. Any further discussion? All those in favor?
Aye.
Opposed? Motion carries. The minutes are approved. We'll move to item number 2. We're seeking approval here that contract number J01B 46000002 Hewlett Packard Enterprises, some hardware installation and training purchases. So we will move to Charles Markakis and Carmen Piccarelli.
Hello, good morning.
Good morning.
Yes, this is for the renewal of the hardware that we're currently running is reached its 5-year end of life. So this is the replacement hardware that runs all of our systems for the MDTA. we'll be happy to answer any questions anybody has.
Any questions from any members? Okay. All right. Is there a motion to approve this item as presented and advance to the full board for further consideration?
So moved.
Okay. Second.
Member Ardinger, I'll second.
Thank you. We have a motion and a second. Is there any further discussion? Okay. All those in favor?
Aye.
Aye.
Opposed? Okay, the motion carries. Thank you, board, and thank you, the two gentlemen here who are presenting today. Thank you very much.
Thank you.
Thank you.
We will move along to agenda item number 3, approval of contract number MT 00211148, WPL janitorial services. And Catherine Anderson is here. Good morning, Catherine.
Good morning. How are you?
Fine, how are you?
Okay, so this is, as stated, MT 002111148 janitorial services for the William Preston Lane Memorial Bridge, the Bay Bridge. The purpose is to retain the services of a community service provider for the provision of janitorial service for 5 buildings at the facility. The provider shall furnish all labor, materials, supplies, equipment, supervision, services, and related incidentals for the provision of professional janitorial services in accordance with the terms, conditions, and specifications in the contract. There are no state allowance amounts within the contract. It was not advertised in bid, as this is a preferred provider contract through Maryland Works. We are recommending award of the contract to NCIA, National Center on Institutions and Alternatives. The bid price was 39.5% below the engineer's estimate. No bid protests or rejections. No MBE goals, sub-goals, or FBR designation. NCI currently holds the current contract at Bay Bridge, as well as Point Breeze, our police headquarters building, and the ICC. NTP is anticipated for December 1st. The current janitorial services contract expires on November 30th. This contract is necessary for professional janitorial services to keep the facilities aesthetically operational in accordance with the terms, conditions, and specifications in the contract. We are seeking to recommend approval to present this contract to the full MDTA board for award of the contract.
Okay, thank you.
Thank you.
Are there any questions from any of the members? Okay. Is there a motion to advance this item to the full board for further consideration?
So moved. Member Carroll.
Member Carroll. Is there a second?
Second.
Thank you, Member Rosen. We have a motion and a second. Is there any further discussion? Okay. All
Thank
those in
you.
favor? All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you very much. Thank you for your presentation today.
Yes, sir. Thank you.
Catherine, thank you. Okay, we will continue to move on here. Next item, number 4, approval of contract number SV 00210586, right-of-way services. And John Wiedemeyer is calling in on this today. Good morning, John.
Good morning, members. I'm homesick, recovering from COVID, so I don't have a camera that's operational. So I'm calling in on my cell phone. This morning, I'm seeking the approval of the Finance Committee of a renewal contract to SV 3028, which is the existing contract that expires at the end of February 2024. This is we seek the approval to send it to the full MDTA board at the next scheduled meeting. The contract is for right-of-way support services. It was advertised as an RFP under solicitation SG00210586. Two proposals were received. They were evaluated both on technical and financial elements. The RFP was where both were of equal importance. The recommended awardee is JMT for first and overall best value to the state as the lowest financial proposal, as well as the first in the technical proposal. The contract exceeds the delegated procurement authority of the MDTA, and therefore has to be sent to the Board of Public Works at the next available meeting. Do I have any questions?
I do have a question.
Pardon me?
I do have a question.
Oh, I'm sorry. Go ahead. Go, please.
Looking at the two proposals, there's about a 72% delta between proposal 1 and proposal 2. John,
Correct.
any thoughts on why there's such a disparity in pricing if the service for the same services, if in fact those vendors might be of like kind and quality?
Well, the problem is that Bowman is a Virginia company, and they have never bidded on any of the MDTA projects before. And
Okay.
I think they were just they were out of their elements in trying to price this out. They're pretty. They did not. Their subcontractors were mainly in Virginia. And I think that was one of the parts of it, is that they basically didn't have experience in Maryland with Maryland MDOT.
Okay, thank you.
I guess.
And
other than that-
JMT is the existing contractee, so.
And we've done our normal fully vetting of this. It's a good question.
Correct.
Okay. Any other questions? Okay. Is there a motion to advance this item to the full board for further consideration?
Member Artinger, I so move.
Okay, thank you, Member Artinger. Is there a second?
I'll second that, Member Carroll.
Thank you, Member Carroll. Is there any further
Thank you.
discussion? Go ahead, I'm sorry. Is there any further discussion? Okay, all those in favor?
Aye.
Opposed? Motion carries. Okay, thank you. And John, I hope you're feeling better. Thanks for attending.
Thank you, appreciate it. I'm on the downside, so
Well, good. Wish you a quick recovery.
thank you. Take care, members.
Thank you. You too. We move to agenda item number 5, which is the last approval item on the agenda today. And we will go to Alan Garman and Clayton Viwig regarding the investment committee report, quarterly review of investment strategy and benchmarks. Good morning, gentlemen.
Good morning. I have my camera on, but I don't know that you can see me. I hope you can.
Yes, we can see you.
Thank you for your
Yes.
time today. Alan and I will spend a few minutes reviewing the financial markets, investment strategies, and portfolios of the agency. In summary, the portfolios remain well diversified and in compliance with all the policy and guidelines. We do pay keen attention to these issues, along with others, in order to ensure the safety of principal and ensure that we're earning reasonable rates of return given market conditions. There are, as you may recall, 2 primary strategies utilized for the investment of the portfolios, one being a matched funding approach, and the second being a total return approach. Returns are measured and tracked for both. Generally, the match funding approach invests in much shorter maturity instruments in order to meet spending requirements for items such as capital projects and debt service. The total return or long-term reserve portfolios are meant to take advantage of normally upward sloping yield curves and thus should generate more compelling returns over the long term. On slide 2, the agenda slide here, again, we're pleased to report the portfolios remain and have been in compliance with the policy and the trust agreement. Certainly, the match funding portfolios or strategies continue to perform well with this inverted yield curve we've seen over the past 12 to 18 months. The team and the investment committee remain committed to the investment approach for these assets. And we also remain true to the buy and hold approach for the reserve portfolios, although at times we do try to take advantage of opportunities as they're available in sectors such as commercial paper and or taxable munis. Moving on to slide 3. As the impact of the Fed's interest rate hikes has taken hold, we've seen measures of inflation rollover, and you can see that in the chart. Indeed, the latest inflation numbers for October, which were published a few weeks ago, indicate the continued deceleration of inflation, and in fact are another 20 basis points or so below what was observed during the September 30 period of the third calendar quarter. Commodity prices also have generally declined during the calendar year. Energy prices are down anywhere from 13 to 47%. Industrial metal prices are down slightly, and agricultural prices are down, with the exception of coffee and sugar. On slide 4, with the rollover in inflation and more recent slowing in jobs growth, I guess the corollary here being modestly higher unemployment, as indicated in the table at the top of the slide, along with measures of consumer activity being tempered. The Fed has actually paused further interest rate increases for the past 2 consecutive meetings, and 3 of the 4 past meetings, there has been no changes in interest rate policy. On slide 5, Alan will go through some of the impact that one might expect to see in portfolio or securities given changes in interest rates. Alan?
Thank you.
Slide 5.
Yeah, we often talk about the unpredictability of short-term, quarterly, or single-year returns as a function of interest rate changes, but we have a little better understanding of expected multi-year returns as a function of the yields that we're purchasing the investments at. And as a reminder, the total return is measured as the market value change plus the accrued interest for a particular security or for the whole portfolio. And we just wanted to highlight that the accruals help to offset, the negative bond price changes in a rising rate environment. And in a higher interest rate environment, you're still subject to significant volatility, but you're less likely to experience negative annual returns as a function of these larger accruals. And we've got a couple of charts to help illustrate this. The bottom chart shows you the very large change in interest rates between September of 2020 and June of 20 and September of 23. That's the lower chart table. Middle table there, we picked 2 securities to help illustrate the effects of the total return in 2 different rate environments. And it's easier to show a single security than the whole, say, general account. What we did was we picked a security that had a similar duration to the entire general account, which is approximately 3. And then we are showing you what happens in terms of total return over a trailing 12-month period. So in the top security, if you were to buy a treasury with a 6% coupon due in 27 at a starting yield of 35 basis points and interest rates rose that year by 100 basis points, you'd have an ending yield of about 1.35%. You can see in the next couple of columns, your initial price was 120% of par. And after the rate rise, the security would decline to a value of 111% of par. So you've got this big negative price return, and it's, partly offset by the accrued interest during that period, but you still end up with a negative 1.66% total return for the year. And I think that first example is illustrative of the environment we're in, at the beginning of the Fed's rate hike cycle. And then you get the second security. It's just the exact same security, but purchased or held in a different rate environment. You have a starting yield of 5%, another 100 basis point rise in rates, hypothetically, and you have an ending yield of 6%. You can see that the price change is not as great. And then the accruals are also, offsetting both in terms of the price change and the coupon interest. So you have a negative price return that's somewhat tempered now at only 3%. And you end up with a total return that's still positive in the year of 3%. So for security in the second example, you're buying it at 5%. And even though you're still having the same magnitude of rate changes, you end up with still a positive return of 3%. So I think the point of this slide is just to illustrate, how bad the returns suffer when we're in that super low rate environment, and then more illustrative of the rate environment we're in now, where the securities that we're purchasing are at yields of 4 to 5%. So I'll turn it back to you, Clayton, for the next slide.
Thank you. On slide 6, we demonstrate the portfolio exposures to various sectors of the fixed income markets. As you may observe, 50% of the assets are invested in agency securities, which while on its face appears high, these investments are primarily allocated to the matched funding accounts and are invested in short-term securities, what are referred to as discount notes. These do constitute multiple maturities, and so there is modest concentration, even for a shorter maturity portfolio, of a maturity in any given month from 1 month out to a year. In other words, there's not a maturity wall. Even these accounts are diversified by maturity. It's just measured in months rather than years. On slide 7, one message we want to convey is again the predominance of matched funding monies, which are invested at the short end. You see this here in the 0 to 1 year maturity bucket. This is consistent. This investment is consistent with staff's assessment of anticipated expenses, again, for such things as capital projects and debt service. As a reminder, at your most recent board meeting, you approved an additional allocation of $50 million to the total return general account. So you will see that 349 over on the right of the table increase and reflected in the next quarterly report. Moving on to slide 8. The primary takeaway here is the notion that the long-term reserve portfolios, the M&A and the general, those two accounts, are not only diversified by issuer and sector, but also by maturity. So we show the maturity profile, which perhaps seems a bit lumpy, but these longer strategy or longer term strategies are managed according to a duration mandate. And so the maturity buckets look a little bit skewed or lumpy, but we refer in the bullets below the bar chart to the duration mandate and talking about staggering the maturities. We do have means to assess and consider real time the duration diversification of these two accounts. Maybe to step back a bit, duration can be considered as a more nuanced way of maturity. And in fact, one definition of duration is simply related to interest rates. In other words, how much will the price of a bond or a portfolio change for a given change in interest rates? And this is a much more relatable metric for purposes of diversification and discussions of risk. Moving on to slide 9, we have our compliance report. As was mentioned earlier, the portfolios remain in compliance with the trust agreement and the investment policy and guidelines. And there is nothing really other than that to highlight here on these pages 9 and 10. Are there any questions at this point? If not, I'll turn it over to Alan for a discussion of our dealer allocation and a proposal for a new dealer to be added to the list.
Thank you. We have a list of approved dealers that are approved by the board, and it's one of the elements that's specifically reserved by the board in its operating policy. I think when you're looking at the allocation of trades, you should expect to see some allocation across, a large group of dealers. We periodically evaluate these dealers' competitiveness, and we could, eliminate them from our list or add new firms. I think it's helpful to highlight that these firms are competing in different spaces for U.S. government agencies, and they're both on the buy and sell side. Wells Fargo tends to be very competitive in the agency space, and you can see that, in these columns, they're number 2 in terms of total trades, but in terms of on the bid side and offer side, you can see when we're selling securities, they won, almost half of the security sales. So that's how competitive they are. And the other firms are, doing their best, but what we experience is the smaller firms, they don't have very large capital bases, and so therefore they don't carry much inventory, and they're not nearly as competitive when you're trying to sell something, and particularly with large size. We've been contacted by a smaller firm called Academy Securities, and they would like to be added to our approved dealer list. We have a dealer questionnaire that pre-screens these firms. We have minimum capital requirements and also registration requirements. So the firm meets those requirements. We don't see any reason to exclude a firm or not try them out. And so we're proposing to the finance committee that we would add and try them out, for a period of time. And then this would need to go to the full board for approval. Are there any questions about the trade allocation or any concerns with adding Academy Securities to our dealers list?
Hearing none, we'll move on to slide 12.
I would just add,
I'm sorry.
I'm certainly, you've just explained you've done your due diligence on this, and appreciate you confirming that. As always, that's what you do. That.
Great, thank you.
I apologize for interrupting.
No, that's fine. On slide 12, this is perhaps a cleaner way to view the match funding total return breakdown for the portfolios. As mentioned earlier, again, the recent approval to increase the general account by an additional $50 million will result in an aggregate reserve position of $400 million going forward. On slide 13, here we provide a brief overview of the strategies and highlights of the policies for the portfolios. You'll also see the indices or the benchmarks that we manage these portfolios against. for performance purposes. And again, as mentioned earlier, there's an overall constraint for the long-term reserve portfolios, that is, of the adherence and management against the duration target. Moving on to slide 14 here, we have a brief discussion on the performance. With the yield curve inversion over the past 12 to 18 months, and their emphasis on short-term investments or maturities, the match funding accounts, namely the capital and bond service accounts, have returned well over 4% for the trailing 12 months. If you'll ignore the two bullets, second and third bullets on the left will highlight the bottom right chart. And note the performance over the 12-month period has been looking very, very good for the portfolios, the dark green and the dark blue being the general and M&O respectively. And it's interesting that the M&O has actually turned in a positive performance for us over the 12-month period versus negative performance number for the index. Again, the capital account typically has maturities exceeding those in the bond service accounts. Therefore, given this yield curve inversion, the bond service accounts have outperformed the capital account.
So Clean, just to be clear, so it looks like we're in line with the agency index for the general, and that is our target for that particular, for those particular returns.
Correct.
Right.
Yes.
Okay. So we're in
Yes.
line. Okay.
Yeah.
But we exceeded it on the M&O
Correct.
for the strikes index. Got it.
Yeah.
Thank you.
Yeah. Yeah. We have a little more opportunity in the M&O given the dynamics of that relative to the shorter maturity constraint for the general account. In other words, we can take advantage of things such as municipal taxables in the M&O that are too rich for us in the general. Anything to add there, Alan?
Yeah, I just think in terms of the M&O reserve, we're managing against a Treasury strips index that's, essentially zero out to, 14 years, 15 years. We look quite a bit different from the index, not in terms of duration. We're taking in theory the same interest rate risk, but the composition of the portfolio, we're investing a lot in taxable munis where we're picking up additional yield. And there are not a lot of securities that are non-callable out beyond 10 years. And so we tend to have a little bit different concentrations in the maturity bands versus the index. So sometimes that works in your favor in terms of the maturity bands and sometimes against us, but certainly buying the municipal bonds at higher comparable yields, that will certainly yield, longer term benefits in terms of total return and helping us in terms of relative returns versus the index. But I think that helps explain, Clay and I spent quite a bit of time in analyzing why we outperformed that index over the trailing 12 months. And it ended up getting into a security by security look about why we're outperforming and trying to assess what portion of the return or outperformance was related to individual securities and what portion of the outperformance was related to where we were positioned on the curve. So I think, we try to replicate the index in terms of total return risk or rate risk, but we will perform slightly differently in different rate environments.
I don't know if it came out as clear what I mentioned earlier either. Generally the industry focuses, for example, on the taxable munis at 5 years and in. And so for us, those tend to be way too rich, and we don't have much interest out past 5 years to 10 years, as Alan mentioned. we find they're a lot cheaper, and we can opportunistically add those to the portfolio as we have room and as is warranted. Finally, moving on to the last slide here. With no further questions, the investment committee requests the finance committee's concurrence and recommendation to move to the full board for approval of the dealer edition and continuation of the investment strategy with the respective benchmarks.
And this will be as one motion for the entire item as presented. First, I just want to thank you for, there's a lot that you all do, the investment committee and everyone involved in this, what you do on behalf of MDTA. And just as, just to confirm, that we are in compliance with policy and other things. And the investment committee is on board, and on the so is based on what has been said here, we've done our due diligence as it relates to the trader dealer, and I guess the new that change or addition. So, are there any? Well, why don't we at this point? Is there a motion to approve this item as presented and advance it to the full board?
So moved.
Thank you, Member Rosen. Is there a second?
Member Ardinger, I'll second.
Thank you, Member Ardinger. Is there any further discussion? Okay, if not, all those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you, board, and thank you, Alan and Clayton, for your presentation this morning.
Thank you.
Thank you.
Thank you.
Motion carries. Okay, we're going to move on to got a couple different, things going on here with my notes, so I apologize for that. We'll move on to agenda item number 6, which is an update. We are now finished with all the approval items, so we'll move on to agenda item number 6, an update on first quarter budget comparisons. Jeffrey Brown is here to present. Good morning, Jeff.
Good morning, all. For the record, my name is Jeffrey Brown, Budget Director for the MDTA, and I'm here today to discuss the budget versus actual performance for the first quarter for fiscal year 2024. As of September 30th, 2023, we have spent 15% of the budget versus a target of 23%. All objects are at or below the targeted spending levels. There's a few primary drivers. One is personnel vacancies, and I'll sound a little bit like a broken record through this. The other one is mainly the seasonality of expenses and year-end accruals and adjustments. What I mean by seasonality is we budget for the most part pretty smoothly throughout the year, but the actual activity for various objects come in lumpy. I mean, invoices come in at different times, purchases occur at different times, and typical, repairs and maintenance usually are heavier in the third and fourth quarter. So those things are tending to drive the variances. Moving into a little bit more detail, salaries and wages are at a 20% spend rate compared to a projected spend rate of 23%. So we're right or just slightly below budget. Communications is at a 7% rate. It's again seasonality, but mostly mostly due to personnel vacancies. Moving on, state paid telecommunications in the communications is object 305, and that's at 0%. And this is what I mean by seasonality. It's one invoice for the state radio system, which has not been billed or paid as of yet, but we do expect this to be on budget. Travel and fuel and utilities are both below budget at a 16% and an 18% spend rate. Motor vehicles and maintenance, Object 7 is on budget with a 23% spend. This is primarily due to Object 701, which is at a 44% spend rate. And again, that's due to the timing of when orders are received for the vehicles. We don't anticipate this being over a budget. We expect it to be on budget. Contractual services, Object 8 is below budget with a 7% spend. You can see the first few objects: advertising, engineers, equipment repairs and maintenance, building repairs, education and training. All of them are tracking well below budget at this point. Again, we expect most of those come back to budget. Again, those are driven by the seasonality and the actual activity of those expenses throughout the year. So that's driving the underspend in the first quarter. In addition, there are things like in advertising, there are some year-end accruals that hit in the first quarter and adjustments, which are skewing the results to be under budget. Management studies, similar to the ones above, it's a very low rate, but again, it's the timing of when we expect these activities to occur. So we do expect this to come back towards budget. IT-related objects is at 13% spend. No concerns at this point. We do expect that to come back to budget. Easy Pass Service Center costs is under budget with a 2% spend rate. This is primarily driven by the year-end accrual in the first quarter and delaying of invoices, which is driving the expenses. This is one that we do want to keep a close eye on. At this point, we expect to be at budget, but again, this is a large item, and we are giving that extra scrutiny because there is the potential of higher costs in there. All others were at a 5% spend rate due, again, to the seasonality of activity in Object 8. Moving on to Object 9, it is below budget at a 15% spend rate. You can see, as I mentioned earlier, roadway maintenance and materials is low, but typically they're heavier in the later part of the year, so it's only at an 8% spend. Salt, as you can expect, we haven't spent any of that at this point, so that's what's driving the lower spend. Replacement equipment, Object 10 is at a 12% spend rate. It's, again, the timing of when some of these orders will come in and the typical seasonality for these various objects. Object 11 is at a 7% spend rate. Other additional equipment is a main driver of that, and it's below budget at 11% spend rate due to, again, as I mentioned, I sound like a broken record, the seasonality. And finally, Object 13 is under budget at 1%. However, this includes the insurance 1309 object, which is 0% spend, but that's our insurance bill for property and property liability insurance. This one we are keeping an eye on because this is expected that this could be above budget. If you recall, we talked about next year's budget with the high insurance premium increases, which were accounted for in that budget. We anticipate that may be occurring in this budget, but that hasn't been budgeted for. So that's something that has the potential to go over budget at this point. That essentially ends my presentation. I'll be happy to take any questions at this point.
Okay. Thank you, Jeff. Any questions? Any members?
Yep. Here's one question. Thank you for the report. In regard to the Easy Pass Center, and I appreciate your comments that we're going to keep a close eye on that. I guess how are we doing that in conjunction with our vendor? And I guess my concern is that we find out about some level of overrun or extra costs after the fact, as opposed to proactively, and what reporting do they have to provide to us so that at least this can be a conversation and discussion so we can get ahead of it.
Okay. Yeah, there's really two ways we're going to be looking at it. One is the one that they have in the past, and I do know there's interactions with the RC managers with the vendors to make sure invoicing's timely, or if it's not, we're aware of it so that we can properly forecast what the expense is going to be, so it's not a surprise with an invoice coming in later. That's one aspect, and the other is, I think was mentioned earlier, is there has been a developed detailed model which drives the forecasts and expected expenditures based upon transactions coming through and things of that nature. So by using those inputs and tracking those inputs and knowing where we think the transactions are going to be, that should give us a better idea of where we actually think the expenses will be and what we will be billed for. So it's kind of a two thing, and the model's more of a newer thing which has been developed over time, but I think it's now kind of matured to the level that we can use it more robustly.
Okay.
Thank you.
Any other questions? Very good question, Member Rosen. I think with no other questions, we will move on. Jeff, thank you very much for all the good work you do on behalf of MDTA.
Okay, thank you.
Okay, we will move on to the next agenda item. Number 7, the update on first quarter budget comparison review of actual versus projected fiscal year 2024 capital budget spending. Jennifer Stump is here. Hi, Jennifer. Good morning.
Hi, good morning, members. For the record, my name is Jennifer Stump, and I'm the Assistant Capital Program Manager. Today is to update the Finance Committee on the status of the actual fiscal year 24 capital spending and the fiscal year 2024 capital budget as presented in the fiscal year 24 to 29 draft Consolidated Transportation Program. This information will also be presented to the board on December 21st. As of September 30th, 9.1% of the fiscal year 2024 budget was spent compared to the targeted spending level of 25%. The total budget for fiscal year 2024 is $539.6 million. The actual spending through the first quarter was $49.3 million. The first quarter percentage is typically low because there are outstanding accruals for work that was completed in fiscal year 2023. 79 of the 83 projects budgeted in the fiscal year 2024 were within acceptable spending limits of 0 to 50%, which is plus or minus the 25% of the 25% target. Due to normal lags in invoicing, generally 2 months, a plus or minus 25% threshold is determined to be reasonable. Actual spending through the first quarter for the 10 projects budgeted for more than $11 million each in fiscal year 2024 was $37.4 million, and those 10 projects are detailed in Attachment A. That concludes this update. If there's any questions or concerns.
Okay, thank you, Jennifer. Any questions from any of the members? Okay, thank you very much.
Thank you all.
Yep, we will move on to the last item on the agenda, number 8, an update, quarterly update on traffic and revenue. Cheryl Lewis Orr. Hi, Cheryl.
Hi, good morning,
Good morning.
everyone. As you mentioned, the purpose of this item is to update the committee on year-to-date traffic and revenue trends. A couple of key takeaways. Our passenger vehicle continues to track closely to the pre-pandemic levels. Commercial vehicle traffic levels continue to outperform pre-pandemic levels. And a note here for the first quarter of fiscal year 2024, there's practically no variance in the forecast versus actual, as the actual traffic and revenue was used for the first 3 months of the forecast. You'll note on page 2, the chart on page 2, we were down about 400,000 transactions compared to last fiscal year. That's about 1% decrease. And again, the forecast is showing no difference. You'll see from attachment A, and I'll explain that in a little bit. For revenue, we're 2.1 million above the fiscal year 2023, and that's mainly due to administrative revenue. And if you go down to attachment A on page 3, you see that we're about $70,000 under budget, and that's due to administrative revenue. The forecast not matching in that area. We did do a preliminary look at October and November, and we are going to be concentrating on commercial traffic. It appears that there may be some variance there, and our administrative revenue with respect to mainly civil penalty fees. We'll be watching those areas closely. But at this point, nothing alarming is standing out. Any questions?
Any questions from any of the members? Okay, it appears not. Cheryl, thank you very much for your presentation this morning.
You're welcome.
Okay, that we have covered everything on the agenda. And that brings us to the final, the adjournment item here. So I just want to say before we adjourn, I just want to thank the board for their participation as always. And those who are traveling, be safe. And then also I want to thank the MDTA team responsible for putting all this together every month, not only for Finance Committee, but so many other things they do for behind the scenes to make this go smoothly. I really do appreciate it, and at least from here in my role, and I know others do too. And it's a lot of work, and it's very helpful information and necessary information. And I really do sincerely appreciate the effort. We have a great team. It's very clear to me. Very great team, top to bottom. So anyway, that's all I have. Is there a motion to adjourn?
So moved.
Second that.
Okay, we have a motion and a second. All those in favor?
Aye.
Aye.
Opposed? We stand adjourned. Thank you all for